Friends, thank you for being here today. It is rare that I feel the need to interrupt your time with family or your daily routines with such urgency, but the data crossing my desk this week is unlike anything I have seen in decades of analyzing commodities. We are standing at a precipice, looking over the edge of a fundamental shift in how the global economy values real assets versus paper promises. What if I told you that the price of silver you see scrolling across the bottom of your television screen, the price your broker quotes you, the price listed in the Wall Street Journal, is essentially a lie? And consider this. If the financial markets are as efficient and honest as the bankers claim, why is the world's largest manufacturing economy currently paying nearly 10 more per ounce for silver than Wall Street claims it is worth? These are not hypothetical questions. They are the keys to understanding a massive silent fracture that has just occurred in the global financial system. While the Western world has been distracted by holiday festivities and stock market rallies, a crisis has been brewing in the physical supply chains of the East. It is a crisis of scarcity, of desperation, and ultimately of truth. Today, I want to walk you through exactly what is happening between the silver markets in Shanghai and New York. We will look past the noise of the daily news cycle and focus on the hard arithmetic that suggests we are on the verge of a historic price revaluation. This is not about speculation. It is about the undeniable laws of supply and demand. Let us begin by examining the warning signal that has emerged in the markets, a tale of two prices. In a normal, healthy global market, the price of a commodity like silver should be roughly the same whether you're buying it in New York, London, or Shanghai. Sure, there might be small differences of a few cents to account for shipping or insurance, what traders call the spread. If silver were 1 point, it was always cheaper in New York than in Shanghai, astute traders would immediately buy it in New York, ship it to Shanghai, and sell it for a profit. This activity, known as arbitrage, acts like gravity. It pulls prices back together and keeps the global market unified. But right now, gravity has been turned off. As we speak, the price of physical silver on the Shanghai Futures Exchange, SHFE, has surged to approximately 80.53 per ounce, when converted from yuan to dollars. Meanwhile, here in the United States, the COMEX paper market, where banks trade digital contracts representing silver, is pricing the metal at roughly 71.80 per ounce. This is a difference of over $9.0 per ounce. In the professional trading world, we do not call this a spread. We call it a broken market. This $9 gap is a screaming siren. It tells us that the arbitrage mechanism, the very engine that balances global finance, has seized up. If banks could buy silver in New York for $71 and sell it in China for $80, they would be doing it with every available dollar. It is a risk-free trade. It is free money. The fact that this gap persists and is even widening leads us to the only logical conclusion. The banks cannot move the metal. They cannot source the physical bars in New York to ship them to China. The paper price says $71, but the physical reality in the East says $80. And in the world of commodities, physical reality always wins in the end. I want to pause here and ask you, do you believe this 9 gap is just a temporary glitch, or are we witnessing the end of the paper market dominance? I'm genuinely curious to hear your perspective on whether the Shanghai price or the New York price represents the true value. Please verify the numbers yourself and leave your thoughts in the comments below. You might be asking, what is driving this unprecedented split? To find the answer, we must look at the panic taking hold in the industrial heartland. To understand why this is happening, we must look at who is buying. If this were a speculative bubble, like Bitcoin or the dot-com stocks of the late 90s, the buyers would be retail traders chasing a chart. But the volume we are seeing in Shanghai is not coming from day traders or hedge funds. It is coming from the factory floor. This is an industrial run on the bank. Now, these are companies that do not buy silver to flip it for a profit. They buy silver because without it, their products do not work. The first major driver comes from a sector we often hear about but rarely understand in this context, the solar industry. For years, Western analysts have comforted themselves with a theory called thrifting. They believe that as the price of silver rose, solar panel manufacturers would simply find ways to use less of it, perhaps substituting it with copper or other cheaper metals. For a long time, this was true. But that narrative has just died a quiet death. The solar industry, particularly in China, which controls over 80% of the global supply chain, has hit a thrifting wall. The physics of electricity generation simply will not allow them to reduce silver content any further without making the solar panels less efficient. Moreover, we are in the midst of a massive technological shift. The industry is moving from older PERC solar cells to new high-efficiency technologies known as TOPCon and HJT cells. While these new panels generate more power, they come with a heavy cost. They require 50% to 80% more silver paste than the old models. Factories in China's Jiangsu province, the heart of global solar manufacturing, are panicked. They are seeing these technical requirements rise exactly as global mine supply is flatlining. We have reports of these factories bypassing standard supply chains entirely. They are not waiting for delivery from refiners. They are going directly to the Shanghai exchange, buying investment-grade silver bars and melting them down to make industrial paste. This is not normal business behavior. This is desperation. They know that 2026 threatens to be a year of silver famine, and they are eating everything in the cupboard before the year even begins. But if solar were the only driver, we might be able to handle it. The second, more explosive factor is the shock coming from the electric vehicle sector. If solar was the only driver, we might see a gradual price increase. But a second, more explosive factor has emerged: the electric vehicle, EV, revolution, specifically the solid-state battery. Just this week, reports circulated regarding Samsung's new timeline for mass-producing solid-state batteries. These are the holy grail of EV technology, batteries that charge in 9 minutes and offer a 600-mile range. However, the chemistry of these batteries is a nightmare for the silver supply. A standard electric car on the road today uses perhaps 20 to 50 grams of silver for its various contacts and switches. These new solid-state batteries, which use a silver carbon composite anode, can require up to 1,000 grams, a full kilogram, of silver per vehicle. That is a staggering 20-fold to 50-fold increase in consumption per unit. China, home to EV giants like BYD and CATL, is watching this development closely. They have no intention of letting a competitor corner the market on the next generation of battery technology. As a result, we are witnessing strategic hoarding. These companies are buying silver not for the cars they are building today, but for the cars they plan to build in 2027. They are treating silver like a strategic weapon. They are price inelastic, meaning they do not care if silver is $70 or $80. They only care that they have the metal and their competitors do not. This insatiable demand leads us to the most terrifying question of all. Why can't the West simply supply this metal? The answer lies in a deepening supply crisis where the vaults are running dry. So we have insatiable demand from the East. Why can't the West simply supply it? This brings us to the most terrifying aspect of the current data. The vaults are empty. We can see the evidence of this crisis clearly in what I call the inventory collapse. If you look at the warehouse stocks of the Shanghai Futures Exchange, the depletion is visible to the naked eye. In 2021, these warehouses held over 3,000 tons of silver. As of this week, they hold less than 800 tons. That is a 75% drawdown in visible inventory. But the situation in New York is even more critical. The COMEX, the primary pricing venue for the Western world, is bleeding metal. On December 23rd alone, just before the holiday break, we witnessed a massive withdrawal. Over 1.4 million ounces of silver were removed from the registered category at the Asahi refinery vault. It is important to understand what registered means. In the COMEX system, eligible silver is metal that is just sitting there, perhaps owned by private families or investors, not necessarily for sale. Registered silver is the metal available for immediate delivery to settle futures contracts. It is the market's for sale sign. When you see 1.4 million ounces vanish from registered inventory in 24 hours, you are watching a bank run. Smart money is grabbing the physical bars and taking them home. This physical scarcity has created a secondary problem, a complete blockade in the logistics chain. This physical scarcity creates a logistics blockade. We are hearing reports from the logistics industry, the people who fly armored cargo from London to New York to Shanghai, that the supply chain is broken. Refineries are booked solid for weeks. If a bank wants to buy silver to ship to China to capture that $9 profit, the refinery tells them, get in line. Even worse, we are hearing of administrative delays in the vaults themselves. When a vault operator takes 48 hours to locate a specific bar's serial number, alarm bells should ring. In a modern, digitized, secure facility, you should know where every ounce is down to the millimeter. Delays suggest the metal isn't where it is supposed to be, or perhaps it has been promised to two different people. Even the London Bullion Market Association, LBMA, often considered the vault of last resort, is reporting delays in allocating metal. If London is dry, the reservoir is empty. Now, we need to talk about the immediate risks facing us right now, specifically regarding Ghost Week and the algorithms that run our markets. This brings us to the immediate danger facing the markets as they reopen. We are entering what traders call Ghost Week, the illiquid days between Christmas and New Year's Day. During this week, senior traders are on vacation. Desks are staffed by junior employees and, more importantly, by automated algorithms. These high-frequency trading HFT bots do not have human judgment. They only understand math. When the markets open, these algorithms will see the data. Silver is $80 in Shanghai and $71 in New York. Their programming dictates a simple command: buy the cheap asset until the prices equalize. They will attempt to buy New York futures. But because it is Ghost Week, there are no sellers. The order book is empty. In a normal market, if you place a large buy order, there are enough sellers to absorb it. This week, a large buy order hitting an empty room creates an air pocket. The price could skip from 72 to 75 to 78 in the blink of an eye because there is no resistance. This creates a gamma squeeze. The banks who sold call options, bets that prices won't rise, will suddenly find themselves losing massive amounts of money. Their automated risk systems will force them to buy more futures to hedge their losses, which drives the price higher, which forces them to buy even more. It is a feedback loop from hell, fueled by a physical shortage that no amount of paper money can solve. We must step back and look at the bigger picture, because we are witnessing the end of Western pricing power. We must step back and look at the bigger picture. This disconnect is not just a temporary trading anomaly, it signals the end of an era. For 50 years, New York and London have determined the price of silver. They used paper leverage, selling 100 ounces of paper silver for every 1 ounce of real silver in the vault, to manage the price and keep it convenient for Western industry and banking. That authority is being transferred violently to the East. Shanghai is now setting the price based on physical need, not paper speculation. The West is becoming a lagging indicator. This represents a profound psychological shift for global industry. For decades, CEOs operated on just-in-time inventory. They trusted that if they needed silver, they could click a button and it would arrive tomorrow. That trust is evaporating. When premiums hit $9 and vaults delay delivery, CEOs shift to just-in-case hoarding. They will buy 6 months of inventory today because they are terrified they won't get it tomorrow. This demand is inelastic. If you're building a $50,000 electric car that requires $80 worth of silver and the price of silver doubles to $160, you do not stop building the car. You pay the price. The cost of silver is irrelevant to the final product's price, but the availability of silver is critical to the product's existence. So, what does this mean for you personally? How should you navigate this storm to protect your wealth? So, what does this mean for you? How should the prudent investor, someone who cares about preserving their retirement and their purchasing power, navigate this chaos? First and foremost, you must rewire your price expectations. First, you must understand that $80 silver is likely not the ceiling, it is the new floor. We are conditioned to think that $50 is an all-time high, a bubble. You must erase that number from your mind. In a world of currency debasement and physical shortages, $80 is simply the fair market value for a strategic technology metal. Do not be tempted to sell your real assets for paper dollars just because the price hits a number that sounds high. You would be trading a scarce asset for a depreciating currency. Secondly, you must be prepared to ignore the volatility in the paper markets. Expect turbulence. Because liquidity is so low, we may see flash crashes. You might wake up one morning and see the paper price on your screen drop to 68 due to a data dump or algorithmic error. Here's the litmus test. If the screen says silver is $68, call your local coin shop. Go to an online bullion dealer. See if you can actually buy it for $68. I guarantee you cannot. The premiums will simply rise to cover the difference. Do not be shaken out of your position by a digital illusion. If you hold physical metal, the spot price is just noise. Finally, let's discuss your immediate action plan to secure physical holdings. We are approaching a state of unobtainium. As the East drains the Western vaults, there's a very real risk that retail investors, people like you and me, will simply be locked out. We may see the buy buttons disappear from websites. We may see shipping delays stretch into months. Historically, the gold to silver ratio sits around 15:1 during times of supply crisis. Currently, it is around 60.1. This suggests that silver is still fundamentally undervalued relative to gold. My most practical advice is this. If you have capital on the sidelines that you intend to allocate to precious metals, do not try to time the dip. Do not try to save 50 cents. Secure the physical ounces immediately while they are still available for delivery. Once the general public realizes that the Shanghai price is the real price, the remaining inventory in the West will vanish in days, not weeks. There is, however, one final dimension to this crisis that we must not ignore: the geopolitical endgame that lurks beneath the surface of these price movements. If we step back from the industrial mechanics of solar panels and batteries, we see a much larger game of chess being played on the world stage. The disconnect between Shanghai and New York is not merely a supply chain failure, it is a symptom of the fracturing of the global monetary order. For decades, the United States has enjoyed the exorbitant privilege of the dollar being the world's reserve currency, allowing us to export inflation and print our way out of debt. But the nations of the East, specifically the BRICS bloc led by China and Russia, have signaled clearly that they are done playing by these rules. Consider the timing. Why is China draining the COMEX now? Why are central banks buying gold at the fastest pace since 1967? Because they are preparing for a world where the dollar is weaponized or devalued into oblivion. When a nation buys U.S. Treasury bonds, they are investing in the debt of a foreign government. When they buy silver and gold, they are investing in a sovereign asset with no counterparty risk. The $80 silver price in Shanghai is a declaration of independence from the Western financial system. It is China saying, "We will no longer trade our real labor and real manufactured goods for your paper IOUs at a discount." This has profound implications for every American retiree holding a traditional 60-40 portfolio of stocks and bonds. The bond market relies on the assumption that the dollar will hold its value. But with the U.S. national debt spiral accelerating past $34 trillion, the Federal Reserve has only two choices: default on the debt, which is impossible, or inflate it away by printing trillions more dollars. They will choose inflation. They always choose inflation. In this environment, holding paper assets is akin to holding an ice cube in a warm room. It may look solid for a moment, but it is melting by the second. We are witnessing a return to sound money principles, not by choice, but by necessity. The East is forcing the issue. By paying a true market price for silver, they are draining the West of its physical wealth, leaving us holding the empty bag of fiat currency. This is reminiscent of the 1970s, but with a critical difference. In the 1970s, the U.S. was a creditor nation with a strong manufacturing base. Today, we are a debtor nation with a hollowed-out industrial core. We cannot simply raise interest rates to 20% to save the dollar as Paul Volcker did, because doing so would bankrupt the U.S. government overnight. Therefore, the silver squeeze is not just a trade for the next 6 months, it is an insurance policy for the next decade. It is your shield against the inevitable devaluation that must occur to reconcile the Western debt bubble. When you hold physical silver, you're not just betting on the price going up, you are betting against the sustainability of a debt-based monetary system that is mathematically guaranteed to fail. The East has done the math. They have made their move. The window for you to make yours is closing rapidly. If you have found this analysis valuable and want to stay informed as this situation develops, please take a moment to like this video and subscribe to the channel. Your support helps us bypass the algorithms and get this critical information to more people who need to protect their financial future. Friends, we are living through a historical pivot point. The era of paper suppressing reality is ending. The era of physical truth is beginning. Ensure you're on the right side of that history. Thank you.